You are watching the news and suddenly you hear it. A company you know, maybe even one you own, just announced a stock split. The stock is going to split 10 for 1. Your heart races. You think, this is amazing. My shares are about to multiply. I am about to get rich. But then you realize something. The total value of your investment hasn't changed at all. You just have more shares at a lower price. So why does everyone get so excited? And more importantly, why do some companies split their stock while others never do? Today, we are going to answer exactly that. We are going to break down why some stocks split and others never do. We will look at the history, the psychology, the strategy, and the one reason that makes some companies completely avoid splits. By the end of this video, you will understand stock splits better than most investors, and you will know exactly why some companies refuse to do them. Let us get into it. Welcome to the channel, where we break down investing concepts in plain, simple English. No complicated jargon, just the truth about how the market really works. Alright, let us jump right in. What actually happens in a stock split? Let us start with the basics, because some of you might not fully understand what a stock split actually is. A stock split is when a company increases the number of its outstanding shares by dividing its existing shares. This reduces the price per share, but does not change the total value of the company or your investment. Let us use a simple example. Imagine a company has 1 million shares outstanding and each share is trading at $100. The company announces a 2-for-1 stock split. After the split, the company will have 2 million shares outstanding. Each share will now trade at $50. Your total investment? Still $100. You had one share worth $100. Now you have 2 shares worth $50 each, same value, just more shares at a lower price. The total market capitalization of the company does not change. Nothing fundamental about the business changes. The earnings, the revenue, the profit margins, everything stays exactly the same. So, why do companies bother doing it at all? That is the million-dollar question. Why companies actually split their stock? Now let us talk about the real reasons companies split their stock. And no, it is not to make you rich overnight. The main reason is psychology. Stock splits make shares more affordable. When a stock price gets too high, it can price out smaller retail investors. A $500 share is intimidating. A $50 share feels accessible. Companies want their stock to be affordable to as many people as possible. More investors means more demand. More demand means a higher price. It is a self-fulfilling cycle. Warren Buffett's company, Berkshire Hathaway, is famous for never splitting its stock. Its Class A shares trade at over $500,000 each. That is not a typo. $500,000 for one share. Buffett does not want retail investors buying and selling his stock. He wants long-term, patient investors who understand the business. A high share price filters out the speculators. But most companies are not Berkshire Hathaway. They want retail investors. They want excitement. They want demand. So they split their stock to make it more affordable. And when they announce the split, the stock price often goes up, because investors get excited about the news. The data on stock split performance. Now let us look at what actually happens to stock prices after a split. Because the data is fascinating. Do you know what happens to the average stock in the year following a split? It outperforms the market by approximately 5% to 10%. Why? Because the split brings attention, it brings new investors, it brings excitement, and that excitement pushes the price higher. But here is the thing, the outperformance does not last forever. Over 3 to 5 years, the performance usually fades, the excitement dies down. The stock returns to its normal behavior. There is also a famous study that looked at stocks that split versus stocks that did not. The stocks that split tended to be high-growth companies. Companies with strong performance. Companies that were doing well. So the split itself does not create value, but the companies that split tend to be better companies. The split is a signal, not a cause. Why some companies refuse to split. Now, let us talk about the companies that never split. The ones that refuse to do it no matter how high their stock price goes. Berkshire Hathaway is the most famous example, but there are others. Google's parent company, Alphabet, did not split its stock for years. They only did it recently after immense pressure. So why do these companies refuse to split? First, they do not want retail investors. They want long-term, institutional investors. They want investors who understand the business, not day traders who will flip the stock for a quick profit. Second, there is a cost. Stock splits cost money. There are legal fees, administrative costs, and regulatory filings. It is not free. Third, some companies believe splits are meaningless. They do not create any fundamental value. So why go through the hassle? Berkshire Hathaway has famously never split its stock for these reasons, and it has worked out pretty well for them, the psychology behind stock splits. Now, let us talk about psychology, because this is where it gets really interesting. Why do people get so excited about stock splits? Why does the stock price go up when the split is announced? It is simple. People think they are getting more for less. If you have 100 shares at $100 each, you have $10,000. If the stock splits 2 for 1, you have 200 shares at $50 each. You still have $10,000, but it feels different. You now own 200 shares. That feels like more. It feels like you are richer. It feels like the company is doing something positive. And here is the kicker. Many retail investors think a stock split is a sign of strength. They think the company must be doing well if it is splitting its stock. And they are not wrong. Most companies that split are indeed doing well. So the psychology feeds on itself. The announcement creates excitement. The excitement brings new buyers. The new buyers push the price up. The price going up confirms the excitement. It is a beautiful cycle, but it is also a trap if you think the split itself creates value. Reverse splits and why they happen. Now, let us talk about the opposite. Reverse stock splits. A reverse split is when a company reduces the number of shares outstanding. Instead of splitting shares, they combine them. For example, a 1-for-10 reverse split means 10 shares become 1 share. If the stock was trading at $1, it is now trading at $10. The one reason that overrides everything. Now let us get to the one reason that overrides everything, the most important factor in whether a company splits its stock. It is the company's philosophy, the leadership's vision, the culture of the business. Some companies believe in making their stock accessible. They believe in retail investors. They believe in democratizing ownership. They split their stock to make it easier for regular people to buy in. Other companies believe in exclusivity. They want their shareholders to be sophisticated. They want long-term holders. They do not want to attract speculators. They do not split. There is no right or wrong answer. Both strategies can work. It depends on what the company wants to achieve, what this means for you. So, what does all of this mean for you as an investor? First, do not get excited about stock splits. They do not create value. They do not make you richer. They are just a cosmetic change. Second, if a company splits its stock, it is usually a sign that the company is doing well. But do not buy just because of the split. Look at the fundamentals. Third, if a company never splits its stock, it does not mean it is bad. It just means the leadership has a different philosophy. Fourth, watch out for reverse splits. They are often a warning sign. The key is to focus on the business, not the stock price. The business creates value. The stock price is just a reflection of that value. That is why some stocks split and others never do. The truth, nobody else is telling you. Now, I have a question for you. Have you ever owned a stock that split? What was your experience? Did it make you money or did it just create noise? Drop a comment below. I read every single one. If this video gave you a new perspective, do me a favor and hit that like button. Subscribe to the channel and turn on the notification bell. We drop new videos every single week. Until next time, stay smart, stay patient, and never fall for the hype.